So welcome everyone. So like I said, last webinar of our series, I think this is our lucky 13th topic, and it's on investors, all about investors. So if you have joined us throughout the entire series, well done. Thank you for joining us so many weeks. If it's your first time, welcome. And you can catch up by watching all the videos. So in the series, we have done a few financing related talks. We had Spring go through general capital planning strategy and things to know. We had the people at Fasken go over corporate structure. We had Mike Volker talk about angels, but I kind of wanted to have a bit of a presentation at the end that just kind of goes through all these different types and also gives you the opportunity to talk to someone who's actively looking at pitches and is kind of in this. And, it's a good opportunity for you to ask questions and learn a little bit more. So we have Brian Martin here from TELUS Ventures today, and he'll go through all the different investor types. And also, we'll make this as interactive as possible. So if you have questions, you want to either unmute yourself for later or put in the chat, we'll give you that opportunity. But first, I'm just going to go through my things. So like I mentioned, we're on the last topic of our seminar series. We've done all these topics previous. You can watch them all online. They're on our YouTube, and also there's a link off of our website, and the slides for the events are also available off of our website. New Ventures BC, in case you didn't hear it before, we are a nonprofit and we're here to work with early stage BC tech startups. So of course, many of you are here for the New Ventures BC competition presented by Innovate BC, but we also have some year-round programming in the form of our distance venture acceleration program, which is a mentorship program for entrepreneurs. And we also have, it says market validation training program here, but this is more online entrepreneurial courses. And we add more courses regularly. We actually just added 5 new topics yesterday. So, so all the info is on our website, newventuresbc.com. Just some upcoming community events to share. These are, friends, partners, collaborators, just a few things coming up. I think Liz is going to post links to all these various programs in the chat. What can I point out for you this week? So Entrepreneurship at UBC, they're an accelerator partner of ours. They are now intaking for a lot of their programs, and I think they have an info session coming up. So if you have a UBC connection, they've got really great free programs that are worth taking advantage of. And also started out of UBC was Creative Destruction Lab West. Well, not started out, but the Vancouver version of Creative Destruction Lab came out of UBC, and they are also accepting applications as well. Otherwise, like I said, our title sponsor, lead partner for the last 10 years, Innovate BC. Our gold sponsors, EY, Fasken, SFU BD School of Business, and the UBC Cider School of Business. Silver sponsors, Ace Tech, TELUS Ventures, Output, Vantech Angel Network, and Volition, and many wonderful bronze sponsors and community members that support both New Ventures and a lot of our startup communities as well, and media sponsors. All right, so you need to get in touch. This is how. Otherwise, I'm going to stop sharing. So Brian from TELUS Ventures can start sharing. So Brian Martin has he gave this talk last year, so this is the second time, so thank you for returning. And he's also volunteers with us as in the competition as well, so it's always great to have you back, Brian. And over to you.
Angie, thank you so much for the warm welcome, and really happy to be here. Always enjoy participating as a judge in New Ventures BC, and happy to share my thoughts today around different investor profiles and ways to approach capital fundraising. I'm going to structure the presentation, and I'm going to go through the various investor profiles, and then my takes on when you should be taking capital from them, have some tips and tricks, and then I'm going to show some current stats on the ventures market, in Canada, which I think will be helpful for those that are fundraising. It can put your fundraise into context, and I'm going to have lots of room for questions through it. So I'm going to power through some of these initial slides. Just by way of background, I'm a partner and investment director at TELUS Ventures. I have a background in engineering and in finance. I was with an early stage startup early in my career over 20 years ago that went public and got acquired by Honeywell. It was in the IoT security space. And then more recently, I've been a VC for about a decade, 2 years with TELUS Ventures. TELUS Ventures is predominantly a growth investor. We do invest earlier in the cycles, depending on our bandwidth. You know, we're a bit stage agnostic, but predominantly a growth investor. And my background and my areas of expertise are within that sort of big data, IoT, security platforms. I've done probably about 34 investments in this space. I've had a handful of exits. So I've seen certainly a lot of transactions and worked with a lot of early stage companies through their growth cycles. So happy to share any knowledge, and again, there'll be a lot of time for questions. Okay, so if you sort of take a look at this graph on the right side of the curve is debt financing, and on the left side of the curve is equity subordinated, so equity financing. And the time basically says as further you go out in time in terms of your startup, are the different areas of venture financing or different financing to explore. So typically, if you're early on, you can do friends and family. You can also do personal credit. Then you have angel and seed rounds. Those are typically done through accelerators. Then you get into shred financing, grants. I'll spend some time on grants. And then you get into the institutional VC rounds, seed A. You've got sub venture debt VCs, B round, C rounds, and then you get into the IPOs and the M&As. So I'll cover a bit of all of these in due course. Particularly at this stage, these would be the areas that I would explore financing. If you're early on, would be friends and family, angels and seed, particularly through accelerators, crowdfunding, grants. I give an overview of the grants, and then VCs, you get into the institutional A rounds. And then also with the shred credits, you can also get into shred financing to accelerate the credits by about a year. I find the interest rates to be fairly attractive if you're managing cash flow to explore shred financing. There's a number of shred financing partners within Canada. My take on this for early stage ventures is I would stay away from all the things marked in X. So me personally, I would not start a company based on personal credit. I think that's too risky, nor would I be exploring bank debt early on or any type of contractor PO financing, operating loans. And I know that there's a lot of people out there that use investment bankers really at the early stage, even to raise sub $2-3 million. I wouldn't recommend it. I'd really try to go first and foremost through traditional mechanisms to validate your product market fit through people that are experienced. I think investment bankers play a role more for later stage and growth financings, and also to help with IPO and M&A. So just some sort of ground rules for fundraising. I think it's really important to take the view of the other person, the person that you're on the other side of the table is, which is all investors need to have the ability to buy the share prices low and sell them and sell high. So when you're going out to raise, I think that really let the market set the valuation, and the valuation should be on reasonable terms that sets the company up for success. I've seen this often, and typically I don't invest if the company has a very high post-money valuation. I don't want to be the person that comes in and then does a down round and looks like a distressed asset. So I think it's very, very important when you're early on to really pay attention to valuations. You know, valuations for angel and seed round, I still believe they're under 10 million in valuation, unless there's some type of really, really deep technology or very, very experienced entrepreneurs. And then it goes up for there. In successive rounds, you're typically selling anywhere between 15 to 25% of your company. So you could think about it in planning, and companies will typically go through about 5 rounds of financing, you know, before they get acquired, or they go through an IPO. The other thing is that when you're putting yourself in other people's shoes, is sort of think about investor returns. So if I were Telus Ventures and I was going to deploy $5 million at a $20 million valuation, and the company gets acquired for $35 million, that's not a really big return for Telus Ventures. We're a $500 million fund, assets under management currently. So it might look like a good return saying, turning 5 into 7.5, getting that $2.5 million, but it doesn't typically move the needle on a VC fund, where you're typically looking for anywhere between 3 to 7x the investment initially, because of the very long hold times. Typically hold times for us will be 7 years. I think industry standard could even be a little bit longer than us. Since we're a little bit of a later stage investor, we have a shorter hold time, where if you look at, let's say, your uncle, or you look at a friend and family, if they said, okay, we're going to take 15,000 and turn it into 50,000, and we do that within a year or two, it's a really good outcome. But different investor profiles are going to think differently. So I think with every conversation, and really not to waste time, is you got to think about who you're approaching, what is going to be a win for them, and what's going to be and then craft your pitch that way. And it should be uniform, obviously, across your different stages. Some more ground rules is that I think that once you raise money, you actually have to be a really great steward of capital. I've seen companies, and unfortunately even some of my own portfolio companies, that have, I believe, after initial fundraising, overspent typically on things that don't build a lot of shareholder value, which would include offices, furniture, build outs, things like that. I think that we're going into some type of recessionary environment here, so I think there's going to be even more scrutiny around operating plans as the capital markets tightened. So really spend the money to create value. And then also, I don't think raising money is necessarily a badge of honors. It's respect entrepreneurs that are able to bootstrap companies to $2 to $5 million revenues, $2 to $5 million in revenue. I think it's tough to build a really big business without taking venture capital. But I haven't shied away from businesses that have services components in them, that are real companies, that have a product market fit, that have early traction, and are able to get to some type of good traction without taking VC funding, and even at a later stage, $5-10 million. I've been the first institution in several times with entrepreneurs that have been able to get to that type of scale. So I think that the less time that you spend raising money is more time that you spend selling your product, building your team. I think the real focus should be on trying to build value from a product market fit, from a services fit. And at the end of the day, the more money you raise, you're just going to be behind a dilution stack. So you see really, really large rounds out there. We'll get to that sort of later in the deck. But I don't think it's necessarily a badge of honor, and it's really commendable to be able to build a nice business without raising a lot of early stage capital, which is also high risk. So I'm going to go through each one of these pretty quickly. So friends and family, I think people could understand what they are. They're the largest source of capital to early stage startups, getting them off the ground. And really raising this type of capital is an ethical decision depending on who you're talking to, because it is high risk capital. So you've got to think about, what does Thanksgiving dinner look like 5 years from now if the money gets lost? Typical check sizes for friends and family, depending on the relationship, will be anywhere between $10,000 to $100,000, with a total round size of between $25,000 to $150,000. I think that gets a lot of people, given the world today of open source software, low code, no code, to some type of MVP. My background is definitely on the software side. So I think biotech and other consumer packaged goods would have a different profile. So I'm just talking, my area, which would be more software-based companies. Your pre-money valuation is typically $1 million, $1.5 million. I couldn't see it getting much more than that because of the risk of the capital. You're typically giving away about 5 to 10% of your company there, really to get off the ground. Typically, these are structured as common shares. Sometimes they get structured as convertible notes or safes, but it's typically treated equally to the common shares. There may be a little bit of a divergence more towards safe notes and convertible notes. I have a preference for convertible notes maybe at this stage, but by and far the things that I'm seeing on cap tables is it's typically common shares. The share structure has already been defined, so it's pretty easy paper to be able to have someone sign to a subscription agreement and just have the same share class that are on the common shares. Founders will typically not give any type of board seat with these types of shares, and the investor relations burden is fairly low. So, you know, at the end of the day, this is typically easy money to get. It's cheap. There's no little impact or control, but there's a lot of high risk relationships because, again, they are your friend, they are your friends and family. Canada's been on a program to create and diversify our economy from natural resources and new construction for probably over about 10, 15 years now, really from the federal and also the provincial levels. And this has created a large volume of grant programs, and also a lot of the funding that goes into VC funds across Canada does come from public taxpayers' money. So I would take full advantage of the grant programs, whether this is SHRED, IRAP, you've got Canada Council, which is money for arts project. Also, a lot of people don't take advantage of the US grants. So if you go to grants.gov, and if you're specifically tackling dual use purpose technologies that can play into the national defense sector, critical infrastructure protection in the US is the dominant player in the world for this, and certainly gives Canadian companies grant money to tackle mission-based problems that they're solving. And the grants are typically non-dilutive work programs. So I would definitely look at the grants.gov and try to source US grants too. The Alacrity Foundation here in BC, I think, is a great foundation. It does a lot of money. It gives money away for marketing, specifically to create e-commerce stores. This is actually hard dollar credits that you can get for Facebook, Instagram ads to actually promote your product. So it's something that I would take advantage of. And last but not least, there's lots of competitions out there, New Ventures BC being one of them. So I think by this point in your phase, if we're going along that timeline, you'd have some type of minimum viable product. You'd at least have something to demo. Maybe you've got some even early stage clients that are giving some feedback on the product, paid or not paid. This is when I would say that you get into the angels and accelerators. This type of funding has, and the two sort of go together, because I feel that angels hang out with accelerators. And I know this because even with the New Ventures BC, there's a lot of angel investors that judge the competitions. There's some really, really good local accelerators. Creative Destruction Labs, Techstars down in Seattle typically takes 2 or 3 companies from BC every single year. So then you get access into the Seattle market, which has, you know, a lot of Fortune 50 companies. You know, it's got Amazon, Microsoft, Boeing, Weyerhaeuser, Starbucks right there. So I'd really also take a look at Techstars, and then you've got some of the more storied accelerators down by Y Combinator. But I've invested from a number of companies that have come from the both Creative Destruction Labs out of BC and also Techstars out of Seattle. So if you're looking like, where do the angels come out of, and we do have our own angel network in BC, but if you want to expand that, I would say look to Creative Destruction Labs and Techstars for a very, very structured accelerator. So angels are typically high net worth. They're people that have had good success in their career, probably have over $5–10 million in disposable income, minus whatever housing assets, their primary housing assets. They will typically write checks anywhere between 50 upwards to 500,000 I've seen. So depending on their conviction in the space and the knowledge of the space. Your round sizes for angel investors will typically be around 250,000 to $1 million. Your pre-money valuation is getting to be $1 million to about $5 million. These, I think I prepared these last year. I'd say that these have been creeped up a little bit since last year, but I've seen angel rounds coming at around $4 or $5 million pre-money. The security type is totally a la carte, depending on what the investor wants. They could be safes, convertibles, preferred shares. I'd say for this, you just want to make sure that you don't have too much overhang before you get into your institutional round. So you don't want to have $5–6 million in safe notes before you go into your convertible, into your price round, because it adds to the stack. But certainly this would be a way to get some money into your cap, into the company when you're in those early days. This is where the clock starts to tick, because these people will want to exit. Sometimes they'll want a board seat. I'd be very careful giving a board seat away at this stage still. If they're writing a very, very big check, north of 6 figures, maybe consider, and they have expertise in the space. But I would say that typically I still don't see a lot of angels sitting on boards. They also tend to write a lot of different checks, so they don't always have a lot of time and sort of see where it goes. Let me give an overview just in case people don't know how the structure of venture capital funds and how they work. This isn't how TELUS works. We invest off of the TELUS balance sheet, and for all of you TELUS subscribers out there, both on the business and enterprise side, the revenue that we generate, we use that revenue then to make ventures investments that are supportive of our strategies going forward. And we've been in operation for 21 years. We've had about 105 direct portfolio companies. We've got a portfolio size of 52 right now. So we're one of the world's largest CVCs by enterprise value, as a percentage of the enterprise value. We're certainly the largest in Canada, and also one of the largest telco CVCs globally. So it's a different model for corporates. So I'm just going to stick to VC funds. A VC fund goes out and fundraises just like a startup. So they don't sit on a pool of capital. What they do is they will get subscription agreements for the life of their fund, typically 10 to 15 years. They'll get these from pension funds, funds of funds, governments. I'd say 60, 70% of all venture capital funds actually gets funding from funds of funds. So there's an intermediary even layer there that then diversifies what a corporation or endowment would do, or a pension fund. Before instead of getting direct investments in funds of funds, it's based on subscription agreements. So every 6 months, maybe every quarter, the fund will then use the subscription agreements and call capital, and then the capital then flows through the venture capital fund and then flows down into the portfolio companies. These specific investors that invest in the venture capital fund, because of the long durations of the hold time. So if you're saying 7 to 8 year hold time from your first check out, that's why venture funds require such a high return on their capital, typically north of 25%, is because the hold times are so long, and there should be a premium for someone to have that much capital locked up and not be able to have the liquidity associated with it. So venture capital funds are looking for really high impact returns to be able to justify the long hold periods. I'm also going to say it's not a very large asset class when you look at bond funding and equity funding, and we'll talk about how much funding has gone into the ecosystem just in a couple of slides, but it's not the biggest asset class. I think there's a lot of buzz, with Silicon Valley, and you see sort of in the Wall Street Journal and even in the Globe and Mail, lots of funding activities, lots of news around VC, but relative to public markets and the bond markets, it's still a relatively niche asset class because of this funding structure and because of the long hold times. From here, we get into the institutional seed rounds. So there's some very good seed investors across Canada. Panache is a really great one, partner of TELUS. They've got offices across Canada. They'd be one of the first institutional checks in. They have a mandate where they deploy a lot of checks into a lot of different companies and try to create diversification. All seed funds do this because the failure rate is so high. And the liquidity probability is so low on these early stage companies, you need to have high diversification across your portfolio. So even on a $50 million seed fund, the initial check size will be probably somewhere between 200,000 to maybe 500,000. $1 million would certainly be on the high side. They typically syndicate with other seed funds and corporations and even the earlier angel stage investors. So they're not doing it alone because of the high risk capital. Pre-money valuations, again, in that sort of giving up 15 to 20% of your company, the valuations will be anywhere between 5 million to 10 million. This is a Canadian context. You would double this in the US, and that's just a fact. So if we're going to look at valuations between Canadian and US companies and these numbers, and if you're pulling up numbers from the US, the US companies will typically raise double the amount of capital at double the valuation at the seed value. But I'm using a Canadian context because I think everyone here largely is probably operating in a Canadian company. The structure is 99% of the deals I see are preferred shares. Legal cost to set this up is typically high, and there will typically be a board seat and protective provisions that are attached with these types of institutional investors, which give them control over and a veto right over future financing rounds, any type of debt the company would take on, an operating plan, and also typically hiring and firing of key executives within the management team. I like working with seed investors that are local. So even with TELUS, I do seed investments internationally, but I try to tend to look for a local partner because you're really building the team at this point. So a good seed investor will be one that helps build the team and recruit the executive team in that seed stage. So, you know, you want to say, okay, well, I need an account executive, or I want to get a product manager, and hit the gas on that. And, you know, the seed investors will probably, given the size of their portfolios, they'll have had exits in them, and will also have past winners, people that they've liked working with, or even people within their other portfolio companies that may be ripe for an elevation, the companies that have exited. So this would be, you know, why I would encourage people to look for local seed financings. Okay, so I'm going to start to do like a little bit more of a roundtable Q&A. I'm going to start presenting some stats, but with that, I'd like to sort of get people's view on this. So if people aren't familiar with the Canadian Venture Capital Association, it's Canada's venture capital and private equity lobbying group and industry association. It's based out of Toronto and Ottawa. They collect stats across all of the financings that are happening. It's reported by the VC and private equity community. So you'll see that there probably isn't a lot of stuff reported on the angel side, but I'd say that there is stuff where you're seeing the 1 million and above. You know, those would be institutional financings, and those certainly get reported. This year, I don't have the Q2 stats yet, so this is Q1. There's been 4.5 billion across 196 deals. Really nice to see that the prairies are picking up some of the venture dollars, particularly Alberta and Saskatchewan. BC had about $500 million in financing. Ontario and Quebec certainly continue to get the lion's share of financing. Much larger geographies, much larger ecosystems. You know, if you look at Montreal, I think it's at least 2, maybe even 3 times the population. I don't think people realize how big Montreal is from a demographic perspective. And then Toronto is obviously our financial hub, and is a big city even by world standards. So it doesn't surprise me that they get a disproportionate amount of the financing here. 25 deals in BC, not too shabby. What's interesting to point out is that there were some really big deals that closed in the first quarter. So there was 17 deals that closed at a total value of 3.3 billion. So you're seeing a heavy skewing, and this has been the trend for the last few years in the US, but now you're starting to see it in Canada, is that the big winners are starting to attract a disproportionate share of the capital so that they can own the entire market. And we saw that with Clio here. We've seen that with some of our ag tech companies, you know, where they're getting these monster rounds really to go for sales and marketing so they can just own the entire market. Something that was very typical for US companies to get. And now we're starting to see that trend in Canada. So this is the stats for Q1. Does anyone want to provide any commentary on sort of what they see in the slide and the trend over the last few years?
You can unmute if you like.
Just unmute and feel free. No one? Well, I'll just point it out. Last year was a bumper year for venture capital in Canada. Like $15 billion in 2021, where the previous years were around $4 to $6 billion. Last year was a huge year in venture capital in Canada. So if you look at this, last year, if you were a Canadian company, was absolutely the hands down best year ever to be raising BC dollars. There was a massive amount of money that was deployed into the Canadian ecosystem last year. And this Q1 for this past year, even though there's been some recessionary and inflationary issues, and we're starting to see some we're starting to see some cooling the markets from a valuation perspective. still a lot of capital deployed in Q1. Certainly a lot more than last year, both by a deal count and also from a dollar investment. So sort of took me by surprise that given how choppy some of the markets were even in Q1, we started to see a big decline in the stock market. It was still a really active quarter for fundraising. So it'll be interesting to see in a month, 4 to 6 weeks, what the Q2 stats look like. But still very clearly a healthy market for venture capital raising in Q1, and a bumper year for last year.
Paige in the chat, Brian, was asking your commentary on what changed in 2021 for such a big increase.
I think there's a couple of factors here. Is that when I go back and I say Canada has made a concerted effort to diversify our economy, to be more technology oriented and not so much reliant on natural resources and housing development, we're starting to see better entrepreneurs and better companies. And better entrepreneurs and better companies are going to attract dollars. So we're starting to see these big mega rounds, and we're starting to see really, really good financials for the companies that warrant this type of investment. I do think that there, as an asset class, there's also been a lot of inflows into VC in general. So there's a lot more VC funding out there as an asset class, because it has gotten really good returns over the last decade. So I think that's a part of it, and that drives up valuation. But I do think it fundamentally goes to is that the pitches that I'm seeing at all levels, seed, Series A, Series B, are so much just a better quality of entrepreneurs, better quality of products than what I saw a decade ago. So we had a lot of big companies, they've exited. If I think of even BC, we had Clio that exited. A lot of those people went over to Copperleaf. Copperleaf raised a big round. So you're starting to see this trickle down effect. And I think this type of investment will even breed better and better entrepreneurs. So that's what I'm seeing as Brian's thing, is it actually comes down to the quality of the companies is improving, which is great. So it proves that the investment in the ecosystem is working.
Great. And sorry, just one more follow-up from Paige. Are these numbers from within Canada? So all the
just
money,
Canada,
just
yeah.
Canadian investors, doesn't include American investors?
No, this would include everything going into the Canadian ecosystem. Okay. Yeah. That's been reported to the CVCA, or the CVCA is scraped, but most of these would include some type of Canadian investor. So if it was a US investor, the Canadian investor would report it to the CVCA. So I think they're fairly accurate, at least at these later stage, the later stage.
Okay, great.
Great questions. Anyone have any insights looking at this? It's a bit of an eye chart. Like just reading it, you can see that the Q1 for seed, if we just go along the left or the right, Q1 for seed was not as strong as it certainly was the previous year. So I think that that shows a tilt towards a little bit more of risk off, where you see a lot more funding rounds going to stuff that has been a little bit more de-risked, that is either earlier stage or late stage. You also see that in a deal count. So if you look at Q1 for seed stage deal, this year there was 82 deals. Last year, oh, these are quarter by quarter. I'm sorry, never mind. I've misinterpreted this graph. I thought the others were quarter by quarter, but it's not. Okay, still healthy. It's still healthy from a Q1 perspective. If we had 369 deals last year from a seed perspective and 219, then we're still on pace from a seed perspective last year. Early stage, still healthy, looks still pretty healthy. Later stage also looks healthy from a Q1. Growth equity, still looks healthy, but you see that huge, like 2021 for the later stage, and the growth equity was just massive compared to the previous years. So just a massive year for VC activity last year in Canada.
Tim made a comment in the chat saying valuations for seeds went up a lot in 2021.
They certainly did. Absolutely. Yeah. We've seen an increasing valuation for all the series, all the stages across, and you can get the valuations more from the US stats than you can, I think, from the CVCA. I'm not sure if the CVCA publishes aggregate valuations, and if they did, I didn't put it in this deck. But you can download the entire report. It's public. I tend to flip through it every quarter, and also at the year end. I think the year end's the largest. It's probably about 80 pages. Just in venture and all the stats. It's a very interesting read, because I think what this does is it says, okay, I'm a seed stage company in Canada. And if there's, I don't know, let's say there's 50 people on this call right now. I can't see the exact stats. So maybe that's 40 different companies that are fundraising. And that's just in BC. It's competitive. Like getting ventures dollars, despite a really robust, is still very tough at the seed stage, given the volume of companies that are out there. So if you do get seed funding, I think it's pretty special, but it's challenging. I do think that raising money at the earlier stages it's very challenging. It always is when you don't have that when you're still early in that product market fit and you're still trying to figure out the financing. Figure out the go-to-market strategy.
Just a couple clarifying questions from Addie about the seed rounds. So for these numbers, these are in Canadian companies, but not necessarily from Canadian-only VCs. Is it fair to say that most seed capital is coming from outside VCs?
I think most seed capital, so I think the numbers here would represent Canadian and US dollars deployed into the Canadian ecosystem. Most US actors in the seed ecosystem, I think, are reluctant to invest without a local partner. I find it rare. I find it rare that you would see an American seed investor going into Canada without having a local funder. I'm not saying that's not the exception. I think it's a bit rare. Conversely, that's how I operate too. So when I do seed investments, I look for a local partner, again, to help build that team. People at the early stage tend to invest in their backyard because they want to work with the companies. Now, COVID may have changed these types of dynamics, but there still is a regional bias towards building companies in one center and having the teams at least somewhat geographically located. Any other questions? If you're looking for the contributing firms, you can also find that within the CVCA. So here's all the contributing firms within Canada. So this, I think, is a good list of who's who investing in Canada, and also the contributing firms. So before we just open it up to any questions, and I'm happy to take any questions whatsoever. I think the number one thing for any startup, like people ask, like, what's the most important thing for a startup, is don't run out of money. Like it's really that simple, is don't run out of cash. Really, you've got to plan the fundraising far in advance. You've got to plan hiring, especially when you have hiring. You've got to make sure that those people are able to keep on getting paid. I've seen people accelerate hiring in absence of funding, and then it gets to be a tricky conversation. Do I lay off the people that I just spent all this time hiring, or do I take a severe down round because I didn't manage my capital well? So you should always know what your cash balance is. You should always know what your runway is, and I would always operate a company with at least 6 months. And if not in this environment, I'm counseling companies to have at least a year of cash, actually, because I don't know how tight the funding markets are going to be. And then beyond that, I think these sort of go hand in hand as you meet your operating plan, over communicate to your investors and interested parties. I love monthly emails. I don't see them that often. I sit on the boards, but I think that companies should really get into a cadence of sending monthly emails to all investors, particularly at the early stage where investors can be helpful. And then again, I talked about board seats earlier, is that I would at your early stage, I would be very, very, very careful about handing out board seats. I do it sparingly. It's very easy to appoint someone to a board, but it's very difficult to move them off of it. And with that, I think that's sort of the formal presentation, if you want to call it that, formal, and happy to answer any questions.
Any final words, Brian, before we wrap up?
I love this. If you have further questions, you can ping me on LinkedIn. I think a lot of you, unfortunately, at this stage, you're really early for where TELUS invests. We're not doing a lot of seed deals right now. We're doing more growth stage this year, but hopefully I'll see you guys in the the competition. I'll be judging it next week, and around town. I pretty visible at a lot of the local events. So look forward to meeting you guys, and really wish you all the success. You know, it's tough being an entrepreneur, it's tough raising capital, and I really commend you on your journey for this.
Okay. Well, thank you, Brian, for both your time today as a volunteer for the competition, and of course, TELUS Ventures for the many, many years of support. TELUS was actually our very first title sponsor 22 years ago as well. So there's a long, long history of great support. All right. Well, with that, I will say have a great afternoon to everyone. Thanks for joining us for today and also the whole series if you were here with us. And thank you again, Brian from TELUS Ventures, for your time.
Thank you, Angie, and the old team from New Ventures BC. Have a good afternoon.
Yeah, have a good one, everyone. Take care.